Investment bonds and education bonds, are they a good way to save for the future? Well, investment bonds, not really. For almost every family, superannuation or a family trust is a better structure to save for the future in. But education bonds, they can really work in some circumstances. So in this video, we're going to work through an example where we compare investment bonds, education bonds, and family trusts to see what works where. Here's our example. Evie and Carl and their two children, Rose 6 and Pete 8. Now, Evie and Carl, like everybody should, have written down their financial goals, and a key financial goal for them is the education of their children. And at the moment, they're thinking about how they'll have the financial resources for the tertiary education of their children after Pete and Rose turn 18. So they have $100K to invest, and they want to invest for 10 years, by which time Pete will be 18, and then to draw down for 5 years. Now, we're always thinking about how we're going to carry value into the future. What's the structure or the channel that we're going to save the money in? And here we can see what we typically have. Evie and Carl could build up equity in their home by paying down their mortgage if they still have a mortgage. They could make before tax contributions to their super, but they won't be able to get the money back, and that won't help them to educate their children. They could make after tax contributions. They could invest in a negatively geared property. That'll be kind of illiquid and difficult to get out of when they need the money. They could put the money into the family trust, and we're going to be talking about that example here, or they could build and own a business. Now, these are the structures that we're usually thinking about. But now we're going to think about whether they could use investment bonds or education bonds, as well as or instead of a family trust. But we're going to start off with the family trust example. And just before we do that, we need to remind ourselves of income tax rates. For 23-24, the tax payable on incomes between 0 and 18,200 is nil. We're going to be making distributions of 18,000, and we'll see that Pete and Rose don't have to pay any tax on that. So now here's our family trust example. So this is the beginning, year 0, and Evie and Carl set up a family trust. They put $100,000 into the family trust through a gift. They could loan the money. Is a loan better than a gift? Well, that's a subject for my investments course. And they make themselves and their children the beneficiaries of the trust. But none of them are ready to receive the income coming out of the trust yet, because Pete and Rose are children, and they'll get taxed at the highest rate if they receive distributions before they're 18, and Evie and Carl are on high tax rates. So they want somewhere to put the money, to store the money. They want a bucket to store the money in until they're ready to distribute it to Pete and Rose when they turn 18. So they're going to use a bucket company, a corporate beneficiary. A corporate beneficiary and a bucket company, those are the same things. They're going to make the distributions into the corporate beneficiary. Now, Evie and Carl are the owners of the corporation, so they have complete control here. They decide what goes in because they're the trustees of the trust. They decide when the corporate beneficiary gets drained and the money gets sent to Pete and Rose. Now, the payment of corporate tax by the corporate beneficiary is going to create franking credits, corporate tax credits, dividend imputation credits. Those three things are the same thing. Franking credits, corporate tax credits, dividend imputation credits. And because these franking credits are the assets of the corporate beneficiary, Evie and Carl have complete control over this. Okay, so in the first year, by the end of the first year, the family trust has earned a return of 8%, and the $8,000, that's 8% of $100,000, is distributed to the corporate beneficiary, not to any of the other beneficiaries. And then the corporate beneficiary has to pay tax, of course, 30% corporate tax. So only 70% goes in here, $5,600, 70% of the $8,000. And 30%, $2,400, goes over here in the payment of corporate tax. But the payment of corporate tax creates corporate tax credits, franking credits, and they're the assets, they're assets of the corporate beneficiary. And now we move forward, and in year 2, there's another distribution of 8%. Of course, it'll be more or less than 8%, but we're just assuming the average amount each year for our example here. And we'll also have the return on the money that was distributed in the first year. So this is going to compound in the bucket company, in the corporate beneficiary. And then year by year, it's going to grow. The bucket company is going to fill up. Year 4, 5, all the way through to the end of year 10, and now Pete has turned 18, and we're ready to drain the bucket company and send the money through the family trust to Pete, who won't have to pay any tax. And so let's look at that. So at the end of year 10, Pete turns 18. Now we're draining the bucket company, and we're going to attach franking credits. So we're paying fully franked dividends out of the bucket company, which is owned by the family trust, into the family trust, and they're being distributed to Pete. And so there'll be a $12,600 dividend and $5,400 of franking credits, 30 cents of franking credits for every 70 cents of dividend. Now remember that Pete won't have to pay any tax because his income is less than $18,200. No tax is due here. And because he doesn't owe any tax, the tax that's already been paid, the franking credits, the credits for tax already paid, that turns into a refund of tax paid. So these franking credits are going to turn into cash, and Pete's going to have $18,000 of cash. Now, the bucket company is not going to drain as quickly as you might think, because there's going to be continued distributions in the following years, and the money that's in the bucket company is going to earn an 8% return. So it's not going to drain as quickly as we might think. But then in year 12, because Rose turns 18, we now start to take fully franked dividends through the family trust to both Pete and Rose. So we're now draining the bucket company more quickly. And now it will start to drain out. Year 13, year 14. By the end of year 14, there's been 5 years of distributions. And $100.8 thousand of cash has come out to Pete and Rose, and $43.2K of refunded corporate profits by the time we get to here. And we can see that here, 5 years of distributions to Pete, 3 years of distributions to Rose, by which time we have drained the bucket company. Now, of course, the bucket company will fill up again. Once we stop making distributions to Rose and Pete, then the bucket company will fill up again. And if we go forward to 10 years, it'll be completely full. And by then, Pete and Rose will be making their own money, and Evie and Carl will have to think about how they're going to drain the corporate beneficiary. Most likely, they're going to do this in their retirement when they have low income. Now, I haven't really explained all the ins and outs of family trusts here. That's really a topic for my investments course, and my investments course is coming up. Here it is. It runs over 10 Thursday evenings from 7 to 9 p.m. They're the live classes, starting on the 2nd of May, 10 consecutive weeks to the 4th of July. And you can also watch the recorded classes on demand. So you don't have to actually come to the classes. The materials are the videos of the classes, and there's a lot of other supporting materials. And the purpose of the course is empowerment and better outcomes, giving you the feeling of empowerment in your investing, that you really know what you're doing and who you can trust, and giving you traction. And then, of course, getting you to better outcomes, to reaching your financial goals more quickly. And so about 2,000 people have taken the course. They have absolutely loved it. You should consider it as well. So go to windlestone.com.au to enroll in the course or to get more information. So that's our family trust example. Evie and Carl put $100,000 into the family trust, set up the family trust, put $100,000 in. They were able to take $144,000 out of the family trust and still have the $100,000 in the family trust. That, of course, they could take out at any time without having to pay tax, a return of capital. Now, we want to see whether investment bonds can do better. If they put $100,000 into investment bonds instead, can they take out more than $144,000 and have the $100,000 left over? Let's make a comparison. So here we are, investment bonds. So they put the money into an investment bond. They buy an investment bond from an insurance company, and Evie is the policyholder. The policyholder has to be defined. And now the money is going to accumulate in the insurance company. So they don't have nearly as much control. They don't own the beneficiary. The money is in the insurance company, and they can choose the type of investment. We'll assume it's the same type of investment as in the family trust. They can choose the type of investment. The tax is paid by the insurance company, and that doesn't create franking credits that Evie and Carl will have access to. Now, over time, just as with the family trust, as we go forward in years, we have the returns on their investment in the insurance company, and we have the accumulation, we have the compounding and accumulation of those returns. And so this grows over time, the same as our previous example. It grows to $63,300. That was the same as in the family trust. But the difference is we don't have access to these franking credits. And now after 10 years, Evie and Carl can't take the money out before 10 years without having to pay extra tax. But after 10 years, they can take the money out and not have to pay any tax. The money comes out through Evie, $12,600. But notice that there's no franking credits attached here. They don't have access to those franking credits. They don't owe any additional tax. And the money can go directly to Evie. It's more flexible in that sense, but they don't get the franking credits. And so eventually we will start to send the money we'll start to draw down money, just as with the family trust for Rose, and then we will take all of the money out over 5 years. And if we make a comparison of an investment bond solution with the family trust solution, we see that we just get to a lot less money. Because we don't get the return of those franking credits, we only end up taking out $100.8 thousand. This is nowhere near as good as the family trust. So you can see in this solution, investment bonds are nowhere near as good as family trusts. So what about education bonds? Let's have a look at how that would work out. Here we are, education bonds. And now Evie and Carl buy an education bond from an insurance company. And Evie is the policy holder and has to be a nominated child. There can only be one child per education bond. So they actually need two bonds, one for Rose and one for Pete. And the two bonds would add up to $100,000 in this exam. And then they're going to make the same type of investments that they made with the family trust and with the investment bond. And so that's going to grow at 8% per year on average. And tax is going to be paid within the insurance company, but they're going to have access to this corporate tax, unlike the investment bonds. And so time goes on, and we know what this is going to accumulate to, $63,300 in our example after year 10. And now they can take the money out. And so Pete has turned 18 after 10 years, and Rose will turn 18 2 years later. But let's say we take the money out through Rose. This would actually be year 12, but that's okay. And so we take the money out through Rose. And what happens here is that Evie and Carl make incur expenses on behalf of Rose and Pete, such as paying their HECS fees, accommodation, books, any kind of educational expenditure. And then they take the receipts for that expenditure to the insurance company and say, we want to claim $18,000 of expenses. And so $12,600 will come out of here, the accumulated returns on the education bond, and $5,400, 30 cents for every 70 cents here, will come out of the accrued corporate tax, the refund of corporate tax. And so you can see this is working in the way just as well as the family trust did, but unlike the investment bonds, and we're getting the corporate tax back. And it looks here as though both children are in the same education bond, but that's not right. Evie needs one bond per child. They just add up to 100K. Just put it like this for simplicity. And so they're going to drain this again over the 5 years, the same as the investment bond and the family trust. But we can see they're going to take out the same amount of money as the family trust. This is just as good as the family trust, although less flexible. But they will end up taking out the same amount of money for the education expenses, but they have to spend the money on education. Now, just before we go on here, there's one thing that we should look at with family trusts and consider, and that is that the money when it came out in the family trust example at the beginning of the video to Rose and Pete, that money could have been recycled back into the family trust. And we can see that here. So when the money was coming out after year 10 through to year 14, and fully franked dividends were paid through the family trust to Pete and Rose, then that money could have been recycled back into the family trust. Now you have to make sure that you are meeting the quite stringent guidelines of the Australian Tax Office, of the ATO, but your accountant knows how to do that. And this is perfectly feasible to meet the ATO's requirements and for the money to go back into the family trust in most circumstances. And again, let me just emphasize that you've got to meet the ATO's requirements, but your accountant will know how to do that in most circumstances. And so when that money gets recycled here, then there's going to be more than $100,000 in here. So more than $8,000 is going to be coming out. So it's going to take longer than 5 years to drain this. In fact, it's going to take until year 16. And by the time the corporate beneficiary has been drained and the franking credits have all been refunded, there's going to be $316,000 in the family trust, which is quite amazing, really. It shows you the flexibility of family trusts. So let's wind up by making a comparison of family trusts, investment bonds, and education bonds. Okay, so now I've added into our table what happens when we recycle the money into the family trust. That because the money hasn't been taken out to Pete and Rose, there's $316,000 in the family trust. And let's make a comparison across the the family trust investment bond and education bonds. In terms of flexibility, family trusts are very flexible. Investment bonds have got some flexibility. The money can be used after 10 years for whatever Evie and Carl want. The least flexible is the education bond. You have to wait 10 years to use the money, and then it has to be only for education. Now, corporate tax refund, family trust and education bond, that's really working, not for the investment bond. Tax efficiency, family trusts are super tax efficient because of the ability, the discretion for distribution across beneficiaries, including a corporate beneficiary, and then being able to store money through time until other beneficiaries are ready to receive the money, store it in a bucket company. Super tax efficient and flexible. Annual fees, this is going to cost about $2,000 if Evie and Carl keep it super simple. Now, that's a lot of money when they only have $100,000 in there. This is 200 basis points, 2% of the $100,000. But by the time they get to $300,000, it's only about 60 basis points or 65 basis points. So it's a fixed cost for the most part, which goes down on a per dollar basis as they have more money in the family trust. Now, over here in the investment bond and the education bond, the insurance company is going to charge them about 70 to 100 basis points for managing it. And then there'll be asset management fees on top of that. But that'll be true in the family trust as well, most likely. But this is just for providing the investment bond and the education bond. And this is variable. So as they get more and more money in there, they're paying higher and higher fees. So no tax if it's taken out after 10 years, no tax after 10 years, but the claims have to be against education expenses. So what's best? Well, in general, family trusts. Investment bonds don't really have a big role here, but in some circumstances, education bonds are going to work. So if Evie and Carl are really concerned with education, this is the purpose of the saving, then they should consider education bonds. If they have a lot of money, they should do it through a family trust. If they have less money, they should do that education saving through education bonds. And the $100,000 example here is intended to be somewhere close to the tipping point. If they had a lot more than 100,000 or significantly more than 100,000, they definitely go with the family trust solution, even in saving for children's education. If they had less than 100,000, then they most likely go for the education bond solution. So that shows us what to do. Now, I hope you found this useful and that you will subscribe to the channel and like this video, and that you'll also think about taking my investments course, which starts on the 2nd of May.